Yeah. Well, thank you for having me. Marianne just gave me an enormous task of just explaining the financial world to you in 40 minutes, but I'll give it a shot. I've called my talk "Money as a Fictitious Commodity." And the concept of fictitious commodity I take from an economic anthropologist called Karl Polanyi, who wrote a very insightful book about the development of market economies in 1944. And he discussed kind of the premises for how market economies work and why they sometimes collapse. And there he highlighted that there are three things in society that can never be treated as commodities, that are not commodities. And when they're treated as commodities, things basically go to hell and we have crisis. And those three things are land, labor, and money. He said if market societies are to work, then we need to make sure that we don't commodify these three things, land, labor, and money, because they are not produced as goods to be traded. And when we start thinking about them as commodities to be bought and sold and priced and valued like this, things tend to go out of control, because then you no longer have market economy, but you get a market society in which the market kind of imperializes everything else. And while it's quite natural to understand or intuitive to understand why land and labor are not commodities, but why money is not a commodity perhaps can be a bit more difficult to understand. But that is because money is meant as just a means of swapping things. When economies get more complicated, it's just a means of something that goes in between when we swap our goods and services that we need or we want to have the lives that we wish to have. But when money kind of takes over and becomes a commodity, Polanyi meant that then things tend to come out of hand. So I'm going to just I'm not going to talk more about Polanyi's theories, but I'm just going to discuss the decades that led up to this crisis that blew up in 2007, is still going on, especially in Europe, as a process of making a commodity out of money again. And it's happened a lot of times during history. We've had a financial crisis are not new, banking crises are not new, debt crises are not new. We've had them, I mean, we can document having them for at least 8 centuries. You have references to financial crises in the Bible. When debt came out of hand, you had debt jubilees where you had to delete a lot of the part of the debt in society because it was just, societies just drowned in too much debt, and you kind of gathered in the village and found out, okay, we need to delete this debt to move on. So you've had a lot of crises during the history. The period where it's, and there's a period that stands out here, and that's a period after World War II and until the 1970s. And then we had a regime called Bretton Woods where capital movements were very strictly regulated. And then you had a lower frequency of crises, and the crises that occurred were less severe. So I do believe that we can control these, if not get rid of financial crises altogether. As the financial crisis, I love this drawing. It's just Bush is standing there. He's the fireman holding out the taxpayer, the little taxpayer that's supposed to break the fall of the huge bloated banks. And this is like a statement that you've had a privatization of profit and a socialization of loss. The financial sector takes the profit, but when they have made bad investment decisions, bad economic decisions, they don't have to take any loss and they don't have to go bankrupt because they go to the state to get bailed out. Because the financial sector is so important today that governments can't let them fail. I mean, in the dramatic months of 2008, September, October, there was a real possibility, especially in the US, but also in Europe, that so many banks were failing that you could have possibilities that cash machines would stop, and that basic services like pulling Visa cards in the store would stop. I'm going to imagine society, just take a second to imagine what it would be like living in Norway. For example, all cash machines and all Visa card transaction would stop and not function for a couple of weeks. It would be a total chaos. So government stepped in and they bailed out banks, mostly without any strings attached. I mean, there are a lot of causes of the financial crisis. I think already social scientists have produced something like 150 books on the topic in the English language, and there are more coming in articles and all that, but I'm just going to give you a brief tour. There was, of course, a lot of deregulation started in the 1970s. You had Thatcher in the UK, you had Reagan in the US. So it was time to liberalize capital. It was time to set the markets free. The government is the problem, not the solution, that kind of thinking. And it was time to set the markets free. And you had a long, sustained period throughout the 1990s and early noughties of low interest rates. You had inflation under control, and government interest rates came down. What happens then is that the financial sector has to go other places to look for returns because interest rates on savings are so low. At the same time, you had a large increase of what is called institutional investors. That means that there are big funds that maybe have hundreds and thousands of investors behind them, small-time savers, stock funds. A lot of you may yourselves be investors through pension funds and different savings funds through your bank. And these are large pools of money, which has some fund manager at the top, going around the globe looking for places to invest, looking for places for higher returns, searching out new places to make money. You had an enormous buildup of debt in the system, and this is partially due to the three factors above that point. There are several other reasons for that, some of which we'll get back to, but that's a seminar on its own. A lot of computer developments that made it possible to trade in all markets over the world. Markets never close. You open in Japan when you close in Europe, and it's possible to trade from wherever to whomever all over the world. You also have increasing computer capacity. There are now algorithms that constitute 70% of all stock trading in the US is done by computers. I mean, there's no human being pressing sell or buy. It's actually just computers that are programmed to search out profit opportunities. And these, of course, can work a lot faster than what human beings... It takes a human being about half a second to press a button, which is presumably what traders, when they buy and sell. Half a second is around 500,000 microseconds. A microsecond is a millionth of a second. So half a second is 500,000 microseconds. A computer can do a trade in 10 microseconds. So these things are going faster and faster and faster. And you're building cables across the Atlantic and across different regions to make sure trades go faster. I mean, they're building a cable now across the Atlantic in order to get the trading time down to 68 milliseconds. The light speed, the time the light uses to go from London to York is about 45 milliseconds. And they're going to do trading in 68 milliseconds. So this also has an enormous impact. It has enormous impact on this crisis. And then you come to what's my favorite topic, which is what I wrote about, is an exaggerated optimism in our ability to quantify, model, and manage risk. In the run-up to the crisis, you had all these financial institutions and the regulators building these very advanced, sophisticated models. They hired people with PhDs in engineering and maths and physics to run these models. They were modeling all kinds of different scenarios, and they put quantified probabilities for this happening and that happening, and they really thought that they were running quite safe operations. And I think that this exaggerated optimism led to us being kind of blind to the risks that we're building. And you also had a series of product innovations, which I'll get back to. The most important ones are securitization and derivatives. And I'll get back to these, and hopefully when you go home tonight, you'll know what securitization and derivatives are, and you may be, because these things come up a lot in the news, and TV2 Nyhetskanal, they will be talking about derivatives market a lot. So, what I think is the best term to characterize what's been happening in the past 3 decades is financialization. And there's also, because I don't think this is a crisis of capitalism per se, but it's a crisis of a specific type of capitalism. It's a crisis of financialized capitalism. And for the most common definition of financialization in my field is that it refers to an increasing importance of financial markets, financial motives, financial institutions, and financial elites in the running of the economy and politics. So that means the important thing that I like about this definition is when people talk about the rising financial sector, it's just about the fact that the sector is growing, it's becoming bigger, it's a lot bigger part of GDP and all this. But what this definition points to is it's not just a growth along economic parameters, but just a financial interest enjoy a greater legitimacy in society at large. I mean, nowadays you can hear how the stock market is doing on practically every news broadcast. It's not just for business investors. You know, our major TV channels report about what's going on on the stock markets. And that's been that's our sign of whether the economy is doing well or not, is whether the stock prices are going up and down. Last week you had a lot of developments in the euro crisis, and the US central bank decided to run another round of printing money basically, and the stock markets really rallied. They went up a lot. So then you had a lot of discussions in the press about whether the euro crisis was over and whether this was the end. And just the fact that you can talk about the euro crisis being over when Greece is approaching a 30% unemployment rate, Spain has 25%, both countries have 50% youth unemployment rate, but people were seriously discussing whether the euro crisis was over last week because investors were doing better, because banks were doing better, and because stock markets were going up rather than down. So what are the signs of financialization? What am I talking about? First, you have all the economic signs, the growth of what's called the FIRE sector, which is finance, insurance, and real estate, which is what kind of group as the financial sector. I mean, they become a larger percentage of GDP. In Britain and the US and France and Germany, the financial sector is 40% of GDP. Just after World War II, they're around 10-12%. They're now 40% of the economy belongs to the FIRE sector. Norway is just 20-23%. It was an enormous increase. There are also more people working there. But above all, if you had a chart showing a cake chart showing the profits in a society, the financial sector is taking a greater part of it. This growth curve is even steeper than their growth of overall GDP or their growth of people working in the sector. You also have increasing financial market activity in non-financial companies. Companies that really aren't financial companies, they make things or they produce other services, but they're increasingly engaged in the financial market. My favorite example is a mining company in Australia called Sons of Gwalia. It was a gold mining company. It was the third largest mining company in Australia. And it was doing well, digging out gold. It was selling a lot. And it decided to make even more money by selling financial instruments that were betting on the gold price in the future. And they sold enormous amounts of these contracts and made heaps of money from it. But then the price of gold turned on them. And suddenly they were holding contracts that obligated them to deliver 6 million ounces of gold immediately. And they had a storage of around 500 ounces of gold and an annual production capacity of 1.5 million. But they had sold these contracts that suddenly obligated them, since the price turned, to deliver 6 million ounces of gold, and they went bankrupt. Not because they weren't able to produce gold in the same way, or not because their methods of extracting gold had become worse, but just because they'd fooled around in the financial markets in order to make more profit than what simply extracting and selling gold could offer them. They went bust. And you have a lot of these examples where companies that really don't belong in the financial sector are kind of engaging in financial sector activities in order to increase their profits, in order to hedge risk, etc. You also have an increase in shareholder value thinking when it comes to corporate governance. And shareholder value thinking is an expression that it's the share price of a company that matters. If it goes up, it means the company is doing better. If it goes down, it means the company is doing worse. You don't think about more other aspects of running a company. It's just a share price. And the CEOs, the directors of these companies, are paid according to how their companies do on the stock markets. So you see that in Norway, like if how much they make, like the CEO of Statoil gets an enormous amount of money. Now his take-home pay is huge. But I don't know whether he's not necessarily a bad CEO, but I'm not sure whether it's a good CEO, whether he's such a fantastic CEO, or whether it's just because the oil price is really high, and you could basically set anyone to run that company, and Statoil would still make humongous profit. But still, he takes home something like 15 million kroners. Financialization also expresses itself in the increase in debt. You have an enormous increase in household debt to income. I mean, Norway is on top there. I mean, we haven't had our housing crisis yet, but Norway has more debt per household debt per income than I think any other country in the world. We are on average 200% debt-to-income ratio, which is larger than what you had in the US before their housing bubble burst. It's larger than anything you saw in Spain or Greece or Italy or Ireland. We have a lot of debt. And you also have, I'm afraid you're going to be kind of pessimistic when you leave here tonight. No. But you also have a large remuneration increases. Paychecks go up. In this financial sector particularly, you have hedge fund bosses taking home something around $250 million per year, which is 1.2 miljarder kroner, the annual salary. Big banking bosses take home around $15 billion, 60, 70 miljoner krona per year in salaries. So this is the things that kind of expresses itself that the financial sector has become so important. You also have political science. It enjoys more political power, and is both because given all this money and all this profit the financial sector generates, it also has a lot of lobbying power. But I think it also has an additional form of power. Gordon Brown, when he was Minister of Finance under Blair, said what's good for the city is good for Britain, and the city is London's financial district. What his point was that if you have what he called light touch regulation, if you make sure the conditions are good for the financial sector in London, then the rest of Britain will benefit. And this is a kind of tweaking of the concept that in the US, an expression of president, I don't remember which one, but one of the US presidents says what is good for General Motors is good for America. So there you have a shift in perspective that back then the focus was on these big industrial companies that made things, and now it's on the financial sector. What's good for the city is good for Britain. The financial sector is no longer viewed as merely a servant to the real economy and infrastructure, but as an engine of growth in its own right. You have a culture of money. You suddenly have big investors and hedge fund managers being in, having portrait interviews in large newspapers and magazines. You have traders and speculators being admired. They're called masters of universe, God, but in a better suit. And a lot of these expressions that we admire these maverick investors that take home $1 billion a year. This expansion of credit can be interpreted in different ways. I tend to just dole out on my negativity, but there is also a positive interpretation that was dominant before the crisis, that this is a democratization of credit, wherein groups that were previously excluded, especially in the US for ethnic reasons, for other reasons, were not getting access to credit markets, now have access, and they have opportunities to buy their own home, to start their own companies, and things that you would want people to have the opportunity to in market economies, that this is a good thing. A more negative interpretation of this enormous expansion of credit is they can be seen as a deliberate political strategy meant to pacify the working and lower middle classes who haven't had a weak or non-existent real income growth in past decades. In the US, the working class of the US haven't had a real income growth in 40 years. They haven't had adjusted for inflation, they haven't had a real income growth. So how are they keeping up in consumption? How are they keeping up with the upper middle class and the upper classes? Yes, they are keeping up their consumption by debt. And it can also be introduced as more of a hazardous exploitation of the poor and of the financially illiterate. You have all these buy now, pay later loans that a lot of people don't understand what kind of real interest rates we're talking about and how expensive these loans are, or these credit cards, that is just the financial sector is exploiting and taking out enormous profits from just exploiting that a lot of people don't understand the financial contracts they enter into. The political aspect of the financial sector is also has some interesting features. Like if you talk about the labor market, you basically have two organized parts. You have laborers that are organized, and you have employers that are organized, especially in countries where unions are still strong, like in Norway. Every year you have the salary negotiations between the large employing institutions and the large labor organizations. And the expectation is that the outcome will be somehow a balance of the interests of these two groups. For the policy field, which is financial regulation, you have an asymmetry there. And on the one side, you have the financial sector, which is extremely well organized. It's very resourceful. It's a very strong lobby group. Well, hardly anyone on the other side is organized. I mean, I'm not organized as a consumer of financial services. I'm not organized as in any policy group that advocates stronger financial regulation, and very few people are. So it's where there's just one side of this sector is active in influencing policy. And I've permitted myself to speculate a little bit about why this is the case. One, financial regulation is a highly technical issue area. I mean, you don't have politicians battling it out on TV about the technicalities of derivatives regulations or banking regulations. It's not, elections are not won or lost on these issues as it is of education and health and security. We also have a discursive treatment of this policy field by the technocrats and by the politicians, I think, that contribute to this. When the head of the central bank gives his speech, he talks more about setting the interest rates as a kind of technical issues, optimizing, tweaking the little instruments of the economy to find the perfect fit. They don't talk about it as a matter of distribution. The central bank director in Norway doesn't talk about who loses and who wins in different policy options. He doesn't talk about how this will affect one or the other group. There are different groups with different interests that are up against each other. This is toned down in the discussion of financial regulation, and it's treated more like a technical matter, best left to the technocrats, best left to the economists, and not really something that politicians and their electorates need to worry about. And an additional problem is that most of us have multiple and partially conflicting roles in global financial markets. We're borrowers on the one hand, we're savers, we're bailout funding taxpayers, we're consumers of financial services. Every time you're on your online banking account, every time you swipe your Visa card, you're using a financial service. So, and the borrowers and savers may have different interests. And in Norway especially, most of us, because we have so much debt, we're focused very plainly on interest rates. We want them to be as low as possible. And if the central bank even threatens to raise the interest rate by 0.5 point, you know, all of Norway is shaking in their pants because we have so much mortgage debt that everyone wants interest rate to be low and to stay low, even though that might hurt our economy in the long run. We're just focused quite simply on keeping interest rates low, that our interest as a borrower kind of overshadows our interest as a saver and as a bailout funding taxpayer and as a consumer in other aspects. And just to give you a brief overview of financial sector lobby, and unfortunately I don't have any Norwegian data, but the US has started to charge at least some of the political spending. Since 1995, they passed a law that said that you have to disclose what you spend on trying to influence politicians. And the financial sector in several of these years spent more than the pharmaceutical industry, which is called Big Pharma in the States, and the military-industrial complex. They spend more than these people. And those are traditionally seen as the big spenders on political influence, but the financial sector spends more. Some estimates say that they approximately spend $1 million per senator. They support both Republican and Democratic candidates so that they're safe, whoever wins. Goldman Sachs, one of the big banks, was the largest single contributor to Obama's campaign. Most of Obama's staff are previous Goldman Sachs employees, which is what I call the revolving doors problem, is that you have a lot of the regulators come from working in the financial sector, and then they work as regulators for 3 or 4 years, and then they go back to the financial sector. And in some cases, especially on the international, you have several revolutions on this, that you can have the same person track the careers of the big international financial regulators, and they've been working in the sector, then they've been working as a regulator, and then they've been working in the sector, and then they've been working as a regulator again, which is that you're not likely to be a very strict regulator if you're hoping for a job in the company you're trying to regulate 2 years later. And just as a comparison, there's this group called Americans for Financial Reform, which are pushing for stricter regulation of the financial sector. They have an annual budget of $2 million, while the US financial sector spends approximately 1.4 million per day. So it's an uphill battle. I want to take you through 3 factors that I think contributed to this crisis, because although we've had crisis many times before, I think that there's something particular about the financialized economy that makes these crises bigger and worse and harder to solve. And I love this picture. It's a picture of a store somewhere in the middle of nowhere in the US where you could get your hair done and your nails done and your gift and get a mortgage in the same store, because they deregulated who could give mortgages in the US, so you could actually get a mortgage from the same person who did your hair, does your hair, do your nails. So it was kind of extreme tendencies where debt here in the form of the home mortgage was just another commodity you could buy it, sell, and who bought it, who sold it to you, didn't need any specific qualifications to sell that debt to you. You could buy it, just get a mortgage anywhere. And these 3 factors that I think contributed to this commodification is securitization, derivatives, and risk modeling. Securitization is a very difficult word for just It means that the bank that gives you a loan sells that loan to other investors. Before, say, the 1970s, if a bank gave Marianne a loan, the bank would sit on that loan and say that if Marianne didn't pay me back, I would be in trouble, I would lose that money. I'm the one who gave that money to Marianne, and if she doesn't pay me back with interest, then I lose that money. What happens today is when your bank gives you a loan, it sells that loan onto other investors. It means that there is an investor behind the bank who gets your payments, your interest payments and your payments of the loan itself. The bank is just an intermediate facilitator. Another problem, and this has expanded enormously in the past decades, and it has advantages if you're thinking about that, if we're talking about democratization of credit, because a bank sells the debt onto investors, it has the ability to give more loans, because it doesn't have to keep capital in reserve. The risk doesn't belong to the bank, it belongs to the investor. So it can give much more credit than one was possible before. But there's also an obvious problem that the person who makes the decision to give a loan or not give a loan doesn't have any of the risk if the loan isn't paid back, because the loan is sold on. So it has no interest in making good financial decisions, because it is paid on, a lot of this is paid on commission. So you're paid on how many loans you are able to give. That's your salary or your incentive, not whether those loans are good decisions or whether they're risky. So this process and that incentive led to a lot of the really bad practices that you saw in the financial crisis that came to the surface, that happened especially in the subprime mortgage, where you had what was called no-doc loans, where you didn't have to document any kind of income. In some cases, you could document what you expect to earn from internet poker or eBay. As that, you had what was called liar loans, where the person offering you the loan encouraged you to lie, to just say what you thought your income might be. And you had a lot of what's called teaser loans, where you get a loan, and for the first 2 or 3 years, you only pay 2 or 3% interest, but after that years, the interest payment balloons up to 12 and 13%. But the idea was that 3 years from now, the house I buy will be worth even more, so then I can just refinance and get a new loan, and this was all. But of course, when the housing market in the US stopped growing, it didn't even have to decline, it just had to stop growing, and then all of these mortgages will face problems. And then you have derivatives, which is the big dark beast of financialized capitalization. Derivatives are financial contracts that draw their value from an underlying financial contract. And that's an extremely complicated definition. So let me just give you an example. And derivatives are not new, to say that they've existed for at least 4,000 years, but you've had an enormous expansion of them. So say if one example is an option. Say that I'm a farmer and I have pigs, but I'm worried that the price of pork might decline so much next year that I might not make a living selling my pork. So I'm interested in drawing up a contract that will guarantee me a price 1 year from now that will make sure I have a living. So if the world pork price drops below that, I can use this contract and go to the market and say that I have the right to sell this many kilos of pork at this price. And on the other end of that contract might be a sausage factory, because they think that pork prices will increase. They have an expectation that these pork prices will go so much up that they won't be able to make their sausages in an economically sound manner. So there you have two legitimate, real economic interests that just have opposing views about what the economy is going to be like 1 year from now, and they enter into a derivative contract in order to reduce their uncertainty. That's a legitimate way to use a derivative. But these, and there you have what I call an option, is this kind of contract that says that you have the right to sell an amount of pork to a set price 1 year from now, but you don't have to. So if the pork prices have really gone up, then it's more beneficial to you to sell at market price rather than at this option price. So then you leave the option. A forward contract is a contract that gives you an obligation. You have to sell at that price, and a swap is where you swap income streams. These details are not important. What's important is that these contracts are a further abstraction, because if the farmer doesn't use this option contract, then it's just all that's happened in terms of economic translation is that the derivative fee has changed hands. And the third factor is what I call risk modeling. With the financial sector, what I talked about earlier is the financial sector and the regulators model risk in advanced quantitative models based on the belief that all or most risks can be measured quantitatively and modeled probabilistically. Some of you might heard former US Secretary of Defense talking about known unknowns and unknown unknowns. He gave this speech about the situation in Afghanistan that's been much ridiculed. He said that in security policy and in defense, you need to make a distinction between what you know you don't know and what you don't know that you don't know. And he was ridiculed for this, but I think it's actually quite it's an interesting distinction, and it's one that's puzzled philosophers for centuries, that what do we know about the future? Is it possible to attach probabilities? Do we know that there's a 5% certainty that that will happen, and there's a 3.3% certainty that that will happen? And the financial sector increasingly thought that all risks they face could be modeled in this way. They attached the most advanced models, and they modeled scenarios for what would happen if Russia defaults, what would happen if there's a storm in Central East Asia that affects crops, and how will this affect market prices? What is the likelihood of Israel bombing Iran, and how will this affect oil prices, and how will this have that? So you had millions of variables that were put into these models and modeled so that banks on the other end of this model came a single number that bank managers could relate to that said how much they stood to lose in the next day. Of course, these models turned out to be wrong, but they had focused so much on them, they had not seen that risks were building in the system. Why are derivatives and securitization contributing to what I call the commodification in money? In the first place, through securitization and trading in derivatives, money can be said to be extra fictitious. Creates multiple intermediate units between the underlying economic unit. That says that, for example, the traditional relationship between the bank and the lender. I mean, in the old days, if say there was just in a home mortgage, they were just maybe Marianne taking out a mortgage and me, the bank, hoping that she would pay it back, and she would pay it back in time and with interest. And now, what a typical house loan looks like is this. So this is the investor on one hand, the guy or the girl who owns the loan and who hopes that it gets paid back with interest. And there's the borrower. But the loan goes through all these it gets packaged in with other loans, it gets sliced and diced and moved around, and there are just so many linkages that you just have so many opportunities for information loss on the way. Almost all mortgages in the US are structured in this way. And the last I heard, which was December last year, because there's still a big mortgage crisis going on in the US, and the Obama administration has pushed quite heavily for renegotiation of that debt. They want banks to go to the mortgage owners and restructure, renegotiate, either cut down on some of the debt or give them longer time to pay it back, so that American families can get their heads above water, and hopefully this will give the economy a boost. But the problem is that even legally the ownership has been muddled, that in this process that was going on during the boom and all this, sometimes the contracts didn't follow all these linkages. So for 60% of American mortgages, it's still not exactly legally clear who owns them. 60%. You really don't know who owns them, because there are several claims that own the same type of mortgage, because the paperwork wasn't kept really neat in all this process. For 60% of US mortgages, you still don't know who owns them. And then there's a whole moral or philosophical perspective of what is the difference between giving a loan and making an investment. If a traditional lender would have more responsibility in terms of helping a troubled borrower get more time, maybe get better conditions to pay back the loan if the borrower finds him or herself in trouble, as is the case in Europe right now, versus if you're just an abstract investor, far, far away from the actual borrower. If the people who own the mortgages of troubled US or European families might be just a pension saver somewhere entirely else in the world, in Japan or in Norway, owning a little bit of that mortgage through these complex processes, that this makes it harder to solve debt crises. I mean, as I said in the beginning, debt crisis has always occurred, and they've been solved in different ways, sometimes in favor of debtors by canceling parts of debts in order to get out of it, sometimes just by inflicting pain on the borrower, to just like, okay, you have to cut down your costs and just suffer it out and pay back your debt and cut down on all other expenses. But my argument is that when you have a process such like this, these debt crises are so much harder to solve and get out of, because there are so many links, there are so many institutions, there are so many cross-ownerships, that it's really hard. For what needs to happen is that the investor and the borrower needs to talk together and find out a solution, because all this debt is really pulling the economy underwater. And look what's happening in Europe, that you need some way to work it out, but that these institutional structures make that the solution is very difficult to get at. I think I'm going to skip this slide, but this is just an example of how the financial sector takes your traditional mortgage and just makes it into all these complex financial products. So what the financial sector did in order to create a lot more profits is just pool together all kinds of loans. And maybe it would take hundreds of thousands of home mortgages, credit cards, and just make a pool, which is like $1,000 million, and just split these up into different categories with different risk profiles, so the investor could choose, like the Norwegian municipalities, their losses came from investing in the so-called senior tranche here, the ones that are quite famous, Norwegian Vik and all these people that lost so much money in the financial crisis. They lost by investing in these. So investors could choose how much risk they wanted to take, because risk was something that could be separated from the loan and priced, modeled and priced, and you created all these instruments, and then you created a new structure out of one piece, and it just goes on, and sometimes there weren't enough mortgages to build all these structures on, and there was so much demand from pension funds that we want to invest in these structures, that you created what's called synthetic CDOs that would follow the price movements of this, because there was just so much demand for all these complicated instruments, because they promised investors that they would deliver higher returns but be just as safe as government bonds or US treasuries, which is thought to be the safest thing that investors can buy. So these promises that we've We've changed our perspective on risk. We can handle it better. We can model it better. So now we can give all investors the opportunity to make more money with less risk than what was possible before. This turned out, of course, to be enormously a big mistake, but it was a very beautiful idea once we believed in it, that you could get more money with less risk. So this grew just exponentially. The CDO market, which is just products in this, grew from 275 million in the year 2000 to a whopping 4.7 trillion. I mean, that growth is just, in 6 years, I mean, it's just not even from million to billion, but from million to trillion. A trillion is 1,000 billion. So from $275 million to $4,700 billion. I mean, in the financial press, you will always hear that these sums are astronomical, but that's a bit unfair. I was told once that by someone who's a friend of mine who's more scientifically oriented, that there are only 200 billion stars in our solar system. So calling it astronomical is a bit unfair on our solar system, because this is way beyond this astronomical. And the derivatives market, it's nominal value. If you add up all the value of, or the price of all these contracts, they added up to $10 trillion in 1989, but by June 2008, it was $760 trillion. And in comparison, the world GDP is still only around 70 trillion. GDP is just the sum of what we believe is the sum of the value of all the goods and services produced in society. So that only, for the entire globe, that amounts to $70 trillion. But there are financial contracts in there. There are probably now more than $800 trillion in financial paper just circulating the globe. I'm going to try to bring this to close. But this is also before securitization and derivatives. The green and the orange part, I forgot to translate that. The green and the orange part constituted all the money, all the credit that was available in societies. There are central bank loans a little bit, and the green one at 19% was bank loans. So now just look at the portion of credit available that securitization and derivatives has made possible, just so much more credit. That little piece of the cake used to be all the money there was available, all the financial paper, but now you have a much larger cake and much more debt running around the system. This is, you just see the risk management paradox, which is again my favorite topic, is that the financial sector really spends a lot more resources on risk management than it did before. I mean, more simple analysis of the financial crisis that they took too much risk and they're too reckless and it was too much gambling. But in fact, my argument is that the financial sector has never been more preoccupied with managing risk and being safe than they have in the past 3 decades. They've been obsessed by it. They pay lots of money for very advanced computer software. They pay lots of money to steal people with PhDs in mathematics and physics. So they spend a lot of money trying to be safe, trying to find a way how to get that dream of getting higher returns with less risk than before. And the regulators were so impressed with this that they let big banks use their own models to determine how much risk they were keeping. What governments do to regulate banks is to say that you have to keep at least some cash in reserve in case the loans you give go bad. That's the main tool through which governments regulate banks. They say that you have to keep something in reserve for how much loan and how much risk you're taking. But after 1996, which is, the regulations that I've been studying, big banks are, because they have so sophisticated risk management software, they're allowed to model and tell regulators that we have so much risk on our books, therefore we keep this amount of capital. Without regulators saying specifically how you should model that risk. The financial sector can choose to do that themselves. They can tweak the models however they like. So of course, the amount of these capital reserves just shrunk. So I think this is a risk management paradox, because I say the financial sector has never been more obsessed or more preoccupied with risk management, and yet we're in the largest and most severe crisis. And this drawing basically sums up my opinion of the problem with this. So why do you only have 40% of an umbrella? Because the chance of rain is only 40%. And this, I think, just sums up the way the financial sector was thinking around risk. And that's a very economically efficient way, because 40% of an umbrella is much cheaper than having an entire umbrella. But when it starts raining, it's not going to help you. And this is what happened. This is what happened in the financial sector. I think I'm going to leave there with that. I hope.